Good evening, everybody. Good evening.
This nation.
Good evening. You're all welcome to tonight's lecture. How has been a day? Hope you've all had a great day. Good evening, Adewale. Good evening, Juliet. Good evening, Uche.
Good evening, sir.
Good evening. How was your day?
Fine, sir. And yours?
Fine too. Fine too. Okay, so we'll be starting now. I don't know why others have not joined, but I've put message on the group for people to join. So I think when they join us, they will meet us. I want us to cover as much ground as possible today. So please let me know if you can see my screen. I'm already sharing the material for today's.
Yes, sir. You can see it, sir.
Okay, good, good, good. Thank you. So without much ado, we're starting. Once again, good evening and welcome to tonight's class. Tonight, we will be looking at the last topic in my part. We've been looking at different topics, and the other lecturers too has been taking us. So tonight, hopefully, I can cover this. Then I think we should have one or two topics left before we finish the whole syllabus for this diet. And the topic we'll be looking at tonight is audit finalization and reporting. Audit finalization and reporting. Now, if you look at the structure of the syllabus or how the ICANN pack is structured, the way the syllabus is that students are expected that at the end of this diet, you will have touched on all the key aspects of audit, starting from obtaining an audit engagement. When you obtain an audit engagement, what you're supposed to do, then it moves on to what approaches to use for the audit. Then from there, you look at how you get audit evidence. Then how you, after getting audit evidence, what you're supposed to do in terms of evaluating internal control, the risk assessment of the business, and everything you do in the course of the audit. Then the part we want to look at now tonight is after you've done your audit, how do you close your audit? You've gotten the engagement, you have the engagement letter, the content specify what the audit will be, the period, the audit fee has been agreed. You've done risk assessment for the entity. You've also carried out internal control evaluation. The components of internal control and control environment have been looked at. You've gotten evidence, they are sufficient, they are appropriate, there are some things you've identified, and all of that. Now you want to finish the audit. So what are the expectations? What's the standard saying as to when you are finishing an audit? And tonight we will look at this in 3 or 4 parts. We'll look at what we call written representation. We'll also look at evaluation of misstatements. Then we'll also look at the overall view of financial statement as well as the purpose of the audit report. And from there, we'll look at the unmodified audit report because that's what the syllabus covers at this level. Then we'll look at key audit matters, and that lastly, we'll look at audit reporting and accompanying and highlights matter. So that's what we'll look at today. We'll look at written representation, evaluation of misstatement, uh, unmodified audit report, key audit matters, and audit reporting and companies allies matter, which is CAMA 2020. So we'll start with written representation. Now, a lot of us must have had written representation, written representation. If I may ask, what's the difference between letter of witness and written representation? Can anybody just try? Can anybody just try? When you say letter of witness and written representation, Or what's different between management letter and management representation? Is anybody trying? You can drop your thoughts in the chat if you don't want to give me your voice, or should I call anybody who is bold enough to just try? Okay, while we are waiting for your response, you can just drop it in the chat. Written representations may be management. They are written statements that are provided by management concerning matters or issues that are risen in the course of the audit to support audit evidence. Now, what is this saying? Written representations are those documented letters or documented statements that management will give to the auditor to support the audit evidence that the auditor have gotten in the course of the audit. So these written representation are demanded by auditors. Management sometimes will give it voluntarily or even without the auditor asking. But if they don't, the auditor is expected to get written representation to support his audit evidence. And why is this necessary? For instance, an auditor is carrying out an audit and the auditor discovers some, maybe in getting audit evidence, he identified that, why is the company using depreciation and standard method for straight line method for depreciation, and maybe in the industry the prevalent method of depreciation is reducing balance. So the auditor needs to ask, why is this different? Usually the auditor is asking for written representation because he wants to put more assurance on the audit evidence he has gotten. Oh, there was a period that maybe the process or the policy in the client entity is that every invoice must have a will be attached to it because maybe it's an inventory industry. And you see a transaction that is just only the invoice, there was no way bill. So what the auditor will ask is that, why is there no way bill? There will have been verbal explanation, but the reason why written representation is very important is that the written representation give credence or give strong support to the audit evidence rather than the auditor just writing that, I got a confirmation from the management that this is the reason why this is. No, it has to be a documented backing to the audit evidence. That's what we're saying here. And the standards that cover written representation is ISA 580. According to ISA 580, the objective of the auditor when it comes to written representation, there are three main objectives that written representation seeks to cover. Number one, the auditor is expected to obtain written representation from management that it has fulfilled its responsibility in respect of financial statement. Now, we all know that the responsibility for preparing financial statement lies with management. Management are responsible to prepare financial statement, not the auditor, not the finance department, not the head of finance, not the finance manager, not the outsource firm. The responsibility is with management. So the auditor needs to get a documented evidence where management will say, we know that is our responsibility for preparing financial statement and we have done so. So they will commit themselves by giving the auditor a written statement that they are responsible for the financial statement. So the ISA 580 is saying that this is the key number one objective of written representation. The second objective, according to ISA 580, why is written representation necessary, is that auditor needs to obtain written representation as appropriate to support their audit evidence. Now, one thing about audit evidence, if you I believe the topic will have been treated some weeks earlier or some time ago, is that audit evidence must be what? Sufficient and appropriate. Now, the sufficiency of an audit evidence will come from the the comfort will come from the backing that the audit evidence has. So no matter the audit evidence that an auditor has obtained, the to show that this audit evidence is sufficient, that means the strength or the how potent the evidence is will be more when there is a written representation backing it. So ISA 580 is saying that one objective of written representation is that auditor needs to support their audit evidence. So when you get written representation, you are giving credence, you are adding substance to the audit evidence. Then the third objective is that written representation are ways by which management, if management did not provide written representation, there are expectations that the standard say auditors should do. So how to respond to appropriately to written representation provided by management, or when they don't provide it, the standard also gives the guideline. So number one thing is that the standard says that written representation should be gotten from management to show that they understand their responsibility for preparing the financial statement, and they are also responsible for the audit. So no matter what is happening in the audit, when the auditor comes, the management will not say, we don't know about it too. So written representation is needed for that. The second thing, written representation is to support audit evidence. Then the third thing that the standard says is that when auditor gets written representation from management, how should they respond to it? What should they look out for? How should they just take it and say, oh, this management will provide written evidence, that's all. Then there are situations that some management will refuse to provide written representation. What should the auditor do? So these are the three main objectives of written representations. Any questions so far? Okay, I'll continue. Now, when an auditor is carrying out an audit, there are many instances that the auditor will be asking for clearance. Oh, why is this thing like this? During the test of control, why is this like this? And management or the person who is assisting the auditor in the course of the will be giving verbal explanation. Oh, the reason why we have this is that, the reason why this branch is closed down for now is this, the reason why. There will be so many verbal discussion between management, and most of this verbal discussion, the auditor will be noting them down in his audit working paper. Now, as much as he has penned it down in his audit working paper, those verbal evidence, in if you have ever seen a working paper or an audit template, you see the way it is what we discuss with management, and a staff probably was made us aware that this is how this is done. All those things will be documented in the audit working paper, but those are not strong audit evidence. The only way the quality of those evidence will show when the auditor has put in that working paper, attached is the letter from management backing this. So that's what written representation does. That all the evidence gotten these are management is owning it. Because if management doesn't own it, for instance, maybe in the course of audit, an auditor is discussing with the staff, oh, why are you doing this? And the auditor explain, and the staff explain, and the auditor pens it down. By the time it gets to management, they might say, no, 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 that's not how we do it. No, that person is just saying this. So what we are saying here is that the auditor needs to get written documented evidence to back written document to back the audit evidence he has obtained in the course of the audit. So that's why written representation is very, very appropriate. Now, there are situations that there are some evidence on their own, they don't need to read written representations. It's not audit evidence that you should get written representation for. And when you have written representation, it doesn't mean you should not have evidence. It's like the two works together. So you have an evidence and you have a written representation backing it. So in a situation where you don't have written representation, it doesn't mean the audio evidence can't stand. It just means that sometimes it's not strong enough. And when you have written representation and you don't have all the evidence, then it's like two leg. The two leg must be there to make it strong. So what we're saying is that although written representation provide necessary audit evidence, they do not provide sufficient evidence on their own. I told you that the two things about audit evidence is that it must be sufficient and it must be appropriate. So if you have only written representation and you are claiming that's the evidence, it's not sufficient. It's when you have the evidence and the written representation is backing it. So it means that on their own, written representation, which can also be called management representation, letter of representation, on their own, they are not audit evidence. And I must quickly say here that letter of representation or written representation, as it's mostly called, or management representations is different. All these three, they are one and same. So if I'm saying written representation, it also means letter of representation or management representation. But they are different or is different from what we call letter of witness. And it's also different from what we call management letter. Letter of witness and management letter are the same, just like management representation, written representation letter are the same, but they are different from each other. Has a question we're starting this class. Written representation is a letter written to auditor to give support or give more credence to audit evidence. Why management letter or letter of witness is a letter that auditor issue after the audit detailing weakness in the control environment. So management letter is like a letter that will document weakness in the control or internal control of an entity and say, these are the areas that are control deficiencies that the client needs to work on. So don't miss the two, because there are students that sometimes maybe mistakes or something, they will be has to explain what a letter of weakness is, and they will be explaining letter of representation. I hope that is clear. Now let's go on. So what happens if a management representation is given to an auditor and the written representation is not supporting the audit evidence? What should the auditor do? Okay, an auditor have identified an audit evidence and is asking for management to give him documented evidence letter to back the evidence. But when management issues the representation letter, he finds out that what the letter is saying is not supporting the evidence. So what should the auditor do? In this case, the auditor is expected to do three things. Number one, he should consider whether his risk assessment of that area is still appropriate. Now, the way auditor comes about audit evidence is either through risk assessment, substantive testing, or test of control. Now, when an auditor, and for all audits, there is a risk assessment that an auditor will have carried out generally for the entity. Now, in carrying out that risk assessment, the auditor might have identify evidence, identify some risk, and all of that. So if an auditor has gotten an evidence based on the risk assessment, oh, there is an high risk in this area, and these are the evidence to support the high risk. But when he is now asking management to provide management representation, they are now giving him a document that is not supporting his view of high risk. Maybe management is saying that that risk is a low risk. Now, number one thing the auditor should do is to consider whether the risk assessment they has carried out is appropriate. Now, if the risk assessment is appropriate, it means it can't use that written representation. Then the second thing is that consider whether additional audit procedures are needed. Now, if based on the management representation or written representation issued by management is different or is not supporting or providing sufficient support to the audit evidence, the auditor might need to carry out more audit procedures. What do we mean by this? An auditor is expecting that when he gets a letter from management to back his audit evidence, he will just be fine. But when the letter is being issued by management, the letter is not supporting, is even contradicting the audit evidence. What the auditor needs to do secondly is to consider, do I need to carry out more audit procedure? Because there are some audit evidence that the auditor might not even need written representation to back up. So if he's convinced that this evidence that I've gotten is strong enough, what management is saying, I need to get more. Maybe you will now need to do more audit procedure to get more finding. Then the last thing he needs to do in situations where the written representation is not backing up or is contradicting the audit evidence is that he should express his concern to management. Oh, I've gotten this evidence. This evidence says that there is no invoice for this transaction. No invoice have been provided. And management is saying that all our transactions there are invoice, that we have the invoice. But I'm not seeing the invoice. Okay, give me instances, give me a letter that shows that this particular transaction has invoice and where is the invoice or what happened to the invoice. Probably the account officer in charge said during that period we have a system downtime and we couldn't issue receipt or whatever, or there was an approval by email that we should treat this transaction. Now the auditor is now asking management to provide documented evidence to support that, and they are saying no. The auditor needs to discuss with management and see what I found. These are the issues. If you are insisting that all invoices were issued at this period and I can't find this, then don't you think there is a concern there? So what we're saying here is that auditor should discuss his concern with management and document those concerns. But if management is now still insisting that the written representation is the truth with that and is contradicting the audit evidence, the auditor might consider withdrawing from the audit. But before the auditor decides to leave an audit, he needs to first ask and verify that he has conducted his own risk assessment appropriately, that he has carried out enough audit procedures to back his audit evidence. And if he's still very certain about his audit evidence, he needs to discuss with management. And if management is not considering his concern, he might need to withdraw from the audit. Any questions so far? And please let me know if you can still see my screen, because I know that the network has been wonderful lately. So if in case you can't hear me or you can't see my screen, just let me know. So we'll continue. So that's what will happen in cases where the written representation issued by management is contradicting the audit evidence. The auditor needs to consider these three things. Now, quickly, let's look at what are the specific requirement that the standard expects written representation to do. The auditor is also required by ISA 50 to obtain other specific written representation for management. So what we are saying here is that there are some general instances that management will just issue a letter to cover the audit. Oh, we are responsible for financial statement. We are also aware of the audit. We discussed. We are responsible. We will provide all books of record. We did this, that. But there are some specific situations that the auditor will need management to write a written representation. And in that written representation, there are some specific things that management needs to own. Number one, management needs to state that it has fulfilled its responsibility for preparing the financial statement, and the presentation of it is fair and is in accordance with applicable financial reporting framework. So it's not just wanting to say we are responsible for financial statement. Management must be able to say that they are responsible for the preparation and fair presentation of the financial statement. This has to be stated. This one is not even verbal. If you've seen maybe terms of engagement for auditor, it will be clearly stated there that the management of so and so and so is responsible for preparation of financial statement and a fair presentation of it, and that is in accordance with applicable financial framework. These are clear written representation that must be gotten by the auditor. The second one is that the auditor should obtain written representation that states that the auditor will be provided with all relevant information. So one of the wordings of the letter is that management must be ready to say, we are ready to provide the auditor with all relevant information to the audit. So the auditor should get that in writing. These are very, very important part of written representation. Then the third thing is that management should also state clearly a documented written statement that all transactions has been recorded and are reflected in the financial statement. So it's one thing to say they are responsible for preparing a financial statement. It's another thing to say all transactions have been recorded and are captured and is reflecting in the financial statement. So the standard ISA 580 is saying that management must put all these things down. So quickly, let's look at how does a letter of representation or written representation looks like. Now, there are some key things that the written representations will have, like we've been talking about. But these are just some of the content, very key content. Number one, it will have a date, it will be addressed to the auditor, but majorly it must have this following statement. One, the written representation must relate to the audit of the client's company. So what we are saying is that the letter should not just be a general letter. The letter must state that this written representation is written for this audit of 2020, 2024 or 2023, and we are the client. This is the auditor. It must be that direct. So the written representation letter must relate to the audit. So it shouldn't be saying like a general statement. No, it must speak to the particular audit that is ongoing. Then the second thing the letter of representation must contain is that the management of the entity, we've discussed this, must have fulfilled their responsibility for the preparation of financial statements. So the letter must clearly state that management has fulfilled their responsibility for preparing financial statement, and that the financial statement gives a true and fair view and is free from what? Material misstatement. So that must be clearly stated. It must also state the assumption that management have made to do their accounting estimate. So we all know that financial statements have accounting estimate. When we say accounting estimate, depreciation is an accounting estimate. Your impairment is an accounting estimate. If it's a consolidated financial statement, goodwill is an estimate. So all those accounting estimates, there are some assumptions that management will make. For instance, if you are doing, I keep saying depreciation tonight, you are doing straight line method of depreciation. There are some assumptions you will have made. If you are doing reducing balance, there are some assumptions you will have made. If you are doing land revaluation or you are revaluating an asset, there are some assumptions you will make. So management must state clearly the assumptions they made to reach accounting estimate and their fair value measurement. We know fair value measurement, that's to your financial instrument. How do they arrive at the values in the financial statement? What assumptions have they made? So management must state it. Then the fourth thing that is expected to be stated in a typical letter of representation, any related party relationship and transactions that must be disclosed. So it is expected that management should state clearly, these are our related parties, these directors are related parties in another sister's company, and all of this must have been disclosed. Then all another thing is all events after the reporting period, either adjusting or non-adjusting event, must also have been disclosed. Then the effect of any uncorrected misstatement, There are some misstatement. When we talk about misstatement, these are errors and omissions. So the effect of any uncorrected misstatement that has seems to be immaterial. We all know about materiality. Most times auditors will focus on materiality. What is material in this instance? So anything that, even management, they have their materiality threshold. So anything that falls below, they might not necessarily have to correct it, but they should state it clearly. They will state it in the disclosure part of the financial statement, and they should also state it in the letter of representation being issued to the auditors. Then the next thing is that the auditor must also be provided with all relevant material, books of account, unrestricted access to individual and entity. When there's one of the terms of the engagement of audit is that all book of accounts and access to individuals as much as necessary should be granted to the auditors. So the auditor should not be striving to meet people or to be going over up and down before he can get access to the document. No, an audit, especially external audit, auditors should have access to all book of accounts. This is even part of karma. Is one of the rights of the auditor to have access to all book of accounts and unrestricted access to individuals in the company. So this will be stated in the letter too. Then the next thing is that all transactions have been recorded. We've also talked about this. So the letter should also state that they've recorded all transactions and is included in the financial statement. Management should also disclose non-compliance with law. So if the client has had issue with regulatory bodies, there have been fines in the past, or there are issues that is pending because of maybe non-compliance, management should also let the auditors be aware. So all these things will be in a documented, written, uh, it's a written evidence that will be issued to the auditor. So apart from this, the auditor might now have cause to ask for others for clarity or for just to support the audit evidence. So these are some of the typical content of the letter of representation. Any questions so far? Please don't be afraid to ask questions though. And if you feel like dropping it in the comment section, please drop it and let me know. Okay, let's continue. Now, what should the auditor do for situations where management refuse to provide this written representation? So the auditor have gotten evidence, or the auditor just signed the engagement letter and is expecting that management will give him the first general letter of representation, or he has discovered an audit evidence and is asking for this written representations, is asking for letter of representation, and management is saying they are playing cold feet, they are not giving him. He asks, he sent mail, he meets the CFO, MD, and they still are not giving him. Now, what the auditor should do, number one, is to have a meeting and discuss the matter with management. That I've been asking for this letter of representation for the past so week. These are the reasons why I need this letter. Don't forget, we are talking about statutory audit. So the auditors should have right and access to any individual in the company. So he will take the matter up with management. Why have I not been provided with written representation? What is happening? What are the issues? And enlighten the client. These are the reasons why I need it. Apart from the fact that it's standard requirement, is also to give credence to audit evidence. So after having this discussion and management still refuse to give him the letter, what should the auditor still do? Now, the auditor might need to reevaluate the integrity of management and reconsider the impact on other representation and audit evidence. So what this means is that if after discussing with management and they still refuse, The auditor might now look at the integrity of management. What does that mean? Management are expected to be straightforward, honest, and equity driven legal people, meaning that they are not supposed to be cunning or have anything of doubt. They are not supposed to be questionable. So if this is happening, the auditor might need to reevaluate their integrity and start thinking about what other things they might be hiding. Could it be a case of money laundering? Could it be a case of financing of terrorism? Now, the auditor needs to start looking at that. And another thing the auditor will need to do is also to start looking at the impact of not having this representation letter on other evidence he has gotten. So, what would be the impact if management didn't give me this letter? What is the effect? What will it translate to as when I'm preparing my audit report? And what are the implications thereof? So these are the things the auditor will need to look at. And lastly, if need be, the auditor might need to consider the effect on his audit report. Now, if all of this will be very significant, the auditor might need to withdraw from the audit. So these are the steps that the auditor should take in cases where management refuse to provide this letter. First, it needs to discuss it with management. If they refuse further, it needs to reevaluate their integrity. Then it needs to look at the impact on the audit evidence. He also needs to consider the effect on the audit report. And lastly, it might need to withdraw from the audit. So these are all about routine representations. Well, we have some past questions that you can go over. If we have time, we'll look at it and we'll see the format of questions around written representation. Usually, the questions are very direct and they are most likely to be any of these points that I've given you. Situations where management refuse to provide written representation. What are the content and form of written representations? When should auditor ask for written representations? What happens if the written representation provided is contradicting the evidence? So most of these three points are what we will be asked in exam. So during your revision, just pay attention to them. You don't need to cram them. Once you go over it and read with what you've heard from me, that should suffice. So quickly, let's look at the next thing. And don't forget what we are looking at: audit finalization and reporting. We are looking at what happens or how do the auditor close the audit. So one of the things is that you've conducted the audit, you've gotten enough audit evidence. So for you to close it successfully, you need written representations. Now, these are some of the things that will lead to how you prepare your audit report. Now, after you've gotten written representations, you've gotten audit evidence, management have provided written representation. What are the next thing we want to look at? The next thing we will look at is evaluation of misstatement. Now, in the course of talking about written representation, there is one key component of written representation. That's what we talked about under number when we are looking at forms and content of written representation, that all uncorrected misstatements must have been what how they have been recorded and what management will need to do about them. So there is a standard that speaks to evaluating misstatements. What that standard is saying is that how do auditor look at or evaluate all errors or omissions that have been identified in the course of the audit. Now, in the course of reviewing the financial statement, the auditor will discover and identify misstatement. Now, anytime you hear misstatement, just think about errors due to omission or fraud. Those are the simplest explanation I can give about misstatement. Errors. It could be errors due to omission. It could be errors due to fraud. Now, when you say error due to fraud, is sounding funny. It just means that it's intentional. It's no more an error. So there are two types of misstatement. One that is as a result of fraud and one that is just genuine error. That means maybe you have omission or you have commission. You're supposed to add something you didn't add. You're supposed to remove something you didn't remove. A value is not supposed to be added. So those are the two areas where you can have misstatement. Now, how is the auditor going to treat misstatement? Now, one key thing in misstatement is that the auditor will set materiality at the beginning of the audit. Materiality threshold. This materiality threshold means that any error, any misstatement above this are material, meaning that there are significant value that the auditor will pay attention to. Now, anything below, the auditor necessarily will, it's not that the auditor won't pay attention to it, but its impact on the financial statement might not be significant. But the auditor will still need to identify it and document it. So ISA 450 is saying that when the auditor is about being is rounding up the audit, the auditor should get a list of all uncorrected misstatements. So there are many misstatements that will have been identified, whether they are material, whether they are not material. Usually the immaterial ones will not be corrected because they don't have impact on the financial statement. But the auditor will still need to list them and attach them to the letter of representations that have been gotten from management. Now, such a list is what is called summary of unadjusted audit evidence. Now, the reason why they are not corrected or they are not adjusted is because they don't have effect on the financial statement. But the auditor will still need to document it. So in documenting it, he will document it along with the letter of representation and audit evidence. So what is ISA 450 saying? The objective of ISA 450 is that what is the effect of all these identified misstatements on the audit, whether it's uncorrected or is corrected? What is the effect on the financial statement? Now, like I've said before, misstatement can be in any form. It can affect the amount. It can even be the classification. You are supposed to classify a liability as probably a contingent liability, or a provision is supposed to be made but is not being made. Classification. Or you are supposed to classify an asset as maybe PP, or you're supposed to do a presentation. How do you present a transaction? Or you're even supposed to make a disclosure in the note, and that disclosure is not made. So these are misstatement. Now, ISA 450 is saying that the auditor is supposed to do the following when it comes to misstatement, especially incorrect misstatement. Number one, the auditor is supposed to accumulate, meaning he's supposed to list all misstatements found during the audit. So you are as an auditor, you've identified misstatement. You're supposed to make a list of all of them. The only reason why you may make a list of them is when it's very, very trivial. Very, very trivial means that is very, very insignificant. But as long as it's misstatement and it's not very, very trivial, the auditor is supposed to make a list of all of it. Now, when you identify and list all these misstatements, the standard is saying that as an auditor, the total of all these misstatements, you will now sum it up and look at the total. Does it approach your materiality that you've set? Don't forget at the beginning of the audit, the auditor will set materiality threshold. Let's say, for instance, the auditor set 100,000 as a materiality threshold for this client. And after during the course of the audit, there are some transactions that were below 100,000. Oh, there is 20, there is 10, there is 5, just like that. Now, the auditor, according to the standard, is expected to list all these misstatements that are below the materiality level because they might not need to be corrected because the auditor is assuming that they won't have effect on the financial statement. But towards the end of the audit, the auditor will list them and sum them together. Is likely and is possible that they will be more when you sum it together than the materiality you set, or they might be very, very close. So the second thing is saying that if the total of misstatements identified during the audit approach, during the audit approach materiality, then the auditor will need to decide if he needs to change the audit strategy or revise it. What we are saying here is that there is a materiality threshold set 100,000. So anything below, the auditor is just documenting it 20, 10, 5, as long as it's below. Now, when you finish and you have the audit evidence, you have your letter of representation, sum up all these uncorrected misstatements that are below materiality level and look at their amount. If it's close to the materiality level you set 100,000, now you now have 90, 80, or it's even more. What it means is that the auditor needs to look at, do I need to reverse and review my audit strategy? Because it means that the materiality you set is not capturing material misstatement. You were thinking 100 is material, but when you now look at all those small small ones, you find out that they are what we call there is this term for it, performance materiality. They are now making significant impact. So the auditor needs to look at it. Do I need to revise my materiality threshold? Then the next thing that the standard is saying is that all these misstatements should be communicated to management. Now the auditor have identified them, he has listed them, he has summed them up. The auditor will not keep quiet. The auditor will now go to management. See, I have some materiality that some misstatement that I've discovered, even though they are not material and they might not have effect on the financial statement. But when I sum them up, they are close to being material. Now, I want you as management to look at this, and if need be, you need to correct this. So, what we're saying here is that if they approach materiality, communicate all these misstatements to the appropriate level of management and request that the misstatement be corrected. So, some management will say, ah, fine, we will correct them, and they will correct them. Now, what happens if management say we are not correcting it? Now, if management refuse to correct this misstatement, the auditor will now ask them why. So, if management refuse to correct the misstatement, the auditor needs to obtain reason for why they don't want to correct it, and he will now evaluate those reasons. Are those reasons enough? Are those reasons, what's the impact of those reasons on the financial statement? So if they say they are not correcting it, would their not correcting it impact the financial statement from being true and fair? If it will affect, then the auditor needs to have there is an issue here. So what the 450 is saying is that the auditor needs to decide what's the impact of incorrect misstatement of financial statement. Now, the next thing is that if these misstatements are not corrected, the auditor needs to now take into account what period will this uncorrected misstatement affect? How will it play out? Because it's very important for the auditor to know the effect of any misstatement on the financial statement, because the objective of the auditor and the objective of audit is that an auditor will make opinion on financial statement whether it shows a true and fair view. For a financial statement to show a true and fair view, it means that the financial statement is showing fair presentation and is free from material misstatement. That's what true and fair view means. So the opinion the auditor wants to express is that whether this financial statement contain material misstatement or it doesn't contain material misstatement. But now looking at uncorrect misstatement that are seemingly immaterial is approaching materiality, and management is saying they don't want to correct it. E now has to look at that effect on the financial statement. It's very, very important. Now, and if they say they don't want to correct it and it's going to impact the financial statement, it means that management now have to have another discussion with those charged with governance. What that discussion will be is that if this thing, if this misstatement is not corrected and is going to affect the financial statement, it might also affect the auditor's report. The auditor's report will come in either way. When we get to auditor report, I will explain further what the auditor's report is like. Now, we said that the auditor is expressing opinion on financial statement. That opinion is expressed in the auditor's report. So whatever opinion the auditor wants to express, whether it shows a true and fair, whether it doesn't show a true and fair, you will see that opinion in the audit's report. And the audit report can be either unqualified, which is the same thing as unmodified, or qualified opinion. Unmodified opinion is saying that there is no need to change anything, everything is fine. But qualified opinion is saying that I have issues with this financial statement, whether it's in the way it's prepared or whether due to the fact that enough evidence were not gotten or there are material misstatement in it. So the auditor will communicate this to those charged with governance or management that if these uncorrected misstatements are not attended to and is going to affect financial statement, it may have effect on the auditor's report. And if they say insist that they are not going to correct it, the auditor will now request representation from management why they believe that these things should not be corrected. Oh, they are saying it's immaterial, and it doesn't have any effect. Okay, give me a letter to back that. The auditor will now document the amount which they said they are not going to correct, all the misstatements that he has identified that have been corrected and those that have not been corrected, and give his own conclusion on whether they are material or not. Now, the way I've explained it is because I want you to understand and let it flow in your mind. By the time you are going over it again, then it can stick. So, is there any question before we go on? Is there, and please still let me know if my screen is on because I'm not looking at the Zoom page. Okay, quickly, let's look at the
Hello, sir.
overview. Okay. The
Hello, sir.
overview. Okay, you have a question. Hello?
Hello, sir. Sir, you said they should communicate with the charge governance, right?
Those charged with governance. Those charged with governance.
That's
Corporate.
the is it to the management now or
Now, let me explain the difference between management and those charged with governance. For listed company, anyways, it's not every company. There are situations where there are some companies that management and those charged with governance are the same. But in listed company are company on the stock market, whether they are publicly traded or privately traded, meaning that there are shareholders. There are some companies too that are privately traded. You won't see them publicly traded. They are on the stock market. They are also listed company. Now, when we say those charged with governance, management are like the I don't know whether it's in your advanced course. They are like those that are saddled with running the day-to-day activity of the business. So under management, you have the senior managers, the head of department, your CEO, head of HR. Those are management. Their responsibility is to run the business. Now, those charged with governance, they are like your board of directors for listed company. Now, in your board of director, you have the CEOs, you have some directors, some part of management. You also have some shareholders and some independent directors who necessarily are not part of management and they are also not part of shareholders. So for listed company, board of directors are those charged with governance. So when you hear corporate governance, is those that own and direct the affairs of the company. Shareholders will form part of board of directors. Some members of management will form board of directors. Then there will be some independent directors. And there are some companies, apart from board of directors, they still have what we call audit committee. So your board of director, audit committee, and shareholders, they are those who call those charged with governance. The reason why they are called those charged with governance is that their focus is usually not on day-to-day running of the business as much as of management, but on the overall corporate governance of the company. So when there are issues of non-compliance, issues of mismanagement, or there are issues of fraud even at management level, the external auditor should speak with them, because there are instances that under your standard for fraud and error, even though it's not the responsibility of auditors to prevent or detect fraud, when an auditor discovers fraud in the course of his work, he's supposed to report it to management. Now, what happens when management themselves are involved in the fraud? That's when you take it higher. So if you look at the point for evaluation of misstatement, the first thing is that he should discuss it with management after listing and totaling the amount. But when management is now refusing to correct this misstatement, that's when he will not take it to those charged with governance. Does that explain your question?
Yes, sir.
Okay, okay. Who asked the question? Sorry. Adejo, Abi?
Yeah, yeah.
Okay, okay. Nice. That's a good question. So let's continue with overall view of the financial statement. Overall view of the financial statement. Now, we all know how a financial statement looks like. Financial statement is your typical details of all that the company have been doing in a particular period. And you have, when we talk about financial statement for an auditor, it's not just your statement of financial position. It's all those five aspect of the financial statement. You have your statement of financial position, your profit statement of your profit or loss or other incomes. You have your statement of cash flow. You have your notes to the account, changes in the equity. So these are all your financial statement, and this is what the auditor will review. So the auditor is reviewing all of this to check. So at the draft level, when management prepared this financial statement, the auditor will need to look at it. So the opinion is not is looking at all that sum of the financial statement. And the reason is analyzing, carrying out substantive testing, analytical procedure, is that the auditor wants to check whether this financial statement makes sense. So there is a holistic review of the financial statement. The review will include whether the client has complied with applicable accounting framework. Now, there are some countries that have their national standard on preparing financial statement. So the auditor will check compliance with that. Now, there are international accounting standards, your IFRS. The auditor will check whether the financial statement has been prepared in line with that. Then there will also be a review of the accounting policies that the entity, or what is the accounting policy this entity is using, and is checking whether that accounting policy is also in line with industry standard. I said something about maybe in the industry, reducing balance is the accounting policy being employed by all other entities. So why is this entity using straight line? So the auditor will check compliance with that. Then will check for adequate disclosure. The disclosure notes to the account is also part of the financial statement. And this is where it's expected that entities should disclose related party transactions, should disclose non-adjusting and adjusting event, and all require disclosure. So the auditor will also carry out a review of that and then carry out an assessment of the information in the financial statement. whether they are consistent. So this is where you will do his ratio analysis, his analytical procedure, prior year comparison, and all of that. Whether the information in financial statement makes sense. So this is what a review of the financial statement means to the auditor. So the auditor needs to carry out this review, and he will do this review on the drafted financial statement made by management. Now, this is just so that you have an idea of what the auditor is doing. Because when the auditor wants to finish his work, management will have drafted the financial statement prepared. The auditor has gone around to get audit evidence. He will now use the evidence to do a review with what management have drafted. And that's why you see that most time when auditors are concluding their audit, they will be asking manager to go and do audit adjustment and go and pass this. They are trying to let the management make sense of what they've drafted. So that we will now go back. Oh, an audit adjustment is being passed. And it's at that situation that all these uncorrected misstatements are also discussed. So that's about review of financial statement. Usually the questions around this are not just they are not very common, but if they want to ask you, they will just ask you what's the overall review that is the auditor will carry out for a financial statement. These 4 points are just the main thing they're expecting, that the auditor will carry out compliance by the client with relevant accounting framework, whether it's a national or accounting standard. It will carry out a review of the accounting policies that the entity has adopted, whether it's in line with industry standard. And it will also carry out a review of the informations in the financial statement, whether they are consistent with business, and lastly, whether appropriate disclosure has also been made. So from there, we'll go to the last part of today's lecture, which is audit report. Now, audit report is where the whole audit will end. The findings, the opinion of the auditor, this is where it will be expressed. Without audit report, the audit is not concluded. So if you're an auditor has come to an office, carry out extensive audit procedure, substantive procedures have been done, test of control, enough audit evidence, management has issued letter, and all of that, and there is no audit report, there has not been an audit. Because the opinion that investing public will need to say, this company is doing well, the issues of going concerns and all of that will be expressed in the audit opinion, in the audit report rather. So what is the audit report, and what is its purpose? Like I said, the audit report is the end product of the external audit procedure. And it's this document that the audit will express its professional judgment on whether the financial statement shows a true and fair view. The financial statement might show a true and fair view. The auditor will state it here. If it doesn't show, the auditor will state it here. And there are four standards that speaks to the audit report. There are some countries that their audit report are guided by national laws, meaning that there are some European countries, even some I think in US, their audit report, the format and the way it should be presented is guided by the laws of that country. But generally, there are auditing standard for how the audit report should look like, and there are four such standard. The first one speaks to the audit report on financial statement, how it should look like, and that is ISA 700. Then the other one, 701, ISA 701, speaks to key audit matters. What are those things that are key audit matters in the audit report? The standard that speaks to that is 701. Then the other one is modification to the opinion. That's 705, where you have whether the opinion should be qualified or unqualified, what type of opinion should you express. That's 705. But that is for the next professional level. The other one too is also for professional level, 706. emphasis of matters paragraph and other paragraph. So that in the audit report, apart from the fact that we have basis of opinion paragraph, we also have other paragraph that tries to bring the attention of the client to some other issue. That's ISA 706, and it's also for your next level. Now, but in this level, we'll just look at the first two, which is ISA 700 and ISA 701, the audit report on financial statement and the key audit matters. So for ISA 700, okay, before we go to the audit report, let's quickly look at audit expectation gap. Now, what is audit expectation gap? Now, the reason why this is here is that a lot of people believe that auditors are just collecting people's money. That if not that audit is statutory, there is no point carrying out an audit. And some just believe that uh, auditors are just to collect people's money, that they are not doing anything. So, but really, why do the public have that opinion? Why do the public believe that auditors are not doing their work enough? Or why do the public expect that audits are not effective? Now, the reason is because of what we call audit expectation gap. Now, audit expectation gap is because the public believes that this is what auditors should do. This is what auditors should achieve for them. But the auditor is saying that this is what I'm supposed to do based on my profession and the standard. So there is a mismatch between what the public, the entity, is expecting the auditor to do and what the auditor is doing based on his profession. So this misunderstanding is because of number one, the public believe that audit opinion in the audit report amounts to a certificate, that when they issue audit opinion is just a document, that it doesn't have any, it can't be relied upon, that they just want to fulfill all righteousness. Then the second thing why the public believe that the auditor has a duty to prevent and detect fraud. Now a lot of people, when they hear audits, auditors are coming, their mindset is that the auditor wants to come and catch thief. They wants to look at who has committed fraud. As much as auditor might discover fraud in the course of their work, that is not the reason for the audit. The reason for an audit is to express opinion on whether financial statements show a true and fair view. Now, some people also believe that when I bring in auditors, I can prevent people from stealing. That's also not the reason for audit, but that's what most people believe, and that's a misperception that is creating what we call audit expectation gap. Now, the last thing is that the public also assume that when auditors are carrying out their work, they will test all evidence, they will test all transactions 100%. But in reality, and even according to standard, it's not possible to test 100% of transaction, because it's just not possible. And that's why we have sampling method in audit. So because of all this misunderstanding, there has been gap between audit its effect and what the public is expecting. And this gap can be best summarized under three types. The first one is standard gap. This means that there is a perception that audit standards are more prescriptive than they are, meaning that audit standards are not wide. A lot of people believe that when you talk about ISA 550, ISA 450, ISA 350, that they are limiting, that they are not covering enough areas as they should. So because they are not covering enough area, then it makes audit not being effective. And that's why a lot of people are saying that audit is not effective, because the standard is limited. So they believe that the audit standard is the reason why the public have this wrong view about audit. Then the second is performance gap. Now, a lot of people believe that this is the perception that audit work has fallen below standard. That audit work, that when you say auditors should come, that there is no big deal about the work. That the work is not achieving much. That if they can't, they are saying it's not their responsibility for this discovering fraud or detecting fraud. Then the work doesn't have the expectation are not being met. Then the last one is what we call liability gap. Some people believe that the auditor is liable to them, whereas the auditor is saying, I'm not liable to you. Take, for instance, somebody who invested in a company because the person saw the audited financial statement. Ah, this company is audited by so, 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 and so. I'm going to buy their shares. And he bought the shares and the company fold up and he's now saying, I must sue the auditor. So some people are saying that this liability gap can create wrong notion about audit. So there are ways that this expectation gap can be addressed. More one of it is to create more knowledge for the public and address it. Then more of it is also that corporate governance code should be strengthened for companies. When we talk about corporate governance, is what I was trying to explain earlier. Board of directors should have clear policies on how government and companies should be run. Then, as a profession, the professional body also should carry out more training for auditors. And what audit firm have been doing is also to have a form of insurance cover when audit go wrong. Most of this will be discussed in your professional level, but it's just an introduction. And you can never tell. I can decide to ask what are the three main elements of expectation gap. So that's the reason why we just have to chip this in. So let's look at what is an unmodified audit report. We'll look at this and key audit matters and we can close for today. I have some past questions I want you guys to look at, maybe one or two before we go if we finish in good time. So we want to look at unmodified audit report. I said that there are four standards that speaks to how an audit report should look like. The first one is ISA 700 and is the unmodified audit report. The second one is 701 and is key audit matters. Why the third one is 705 and is how when you modify opinion in the audit report. So that's modify opinion. Why the last one 706 speaks to emphasis, paragraph, and other matter. Now the first one is talking about when a report is unmodified. And what do we mean by an audit opinion being modified or an audit report is unmodified? What it simply means is that you don't need to change anything. So an unmodified audit report is an audit report that contains an audit opinion not modified in any way, either by changing the opinion to a qualified opinion or by adding extra paragraph. You don't need to add anything. That's what unmodified is saying. You've gone through the audit, you have the evidence, and when you finish, you just discover this financial statement is showing a true and fair view. There is no need to say, pay attention to this, do this. It's what we call a clean audit report. So ISA 700 requires the auditor to give an unmodified opinion when he concludes that the financial statement has been prepared in all material respect in accordance with applicable financial reporting. So what we're saying here is that when the auditor is reviewing a financial statement and is discovered that this financial statement has been prepared and there is no material misstatement, is showing a true and fair view, the right applicable financial framework is being used, the auditor is expected to give an unmodified opinion. In layman's time, is what you call a clean report. Now, the objective of ISA 700 is to form an opinion on the financial statement based on evaluation of conclusion drawn from the audit evidence. So when you've gotten audit evidence and you see that this financial statement is fine, you issue what we call unmodified opinion. So that's what is a 700 cover. And that you will express this opinion through a written report. So when you are given an unmodified audit report, in that audit report, it will be clearly stated that this financial statement shows a true and fair review, and that's what unmodified audit report is. Now, the unmodified report gives what we call a high level of assurance. If you remember that topic when we talk about level of assurance, we have reasonable assurance, we have limited assurance. A high level assurance is one that gives, based on the level of audit evidence you've gotten, is a positive type of assurance, and is the only one that you find in an audit. So unmodified opinion gives that kind of assurance. So it's very, very important to know that. And how would the auditor arrive at an unmodified report? So what are the situations that will make an auditor to give unmodified report, saying that this report is presented in, in accordance with financial framework, is free from material misstatement? For an auditor to reach this opinion, the auditor will be required to evaluate and must have obtained sufficient appropriate audit evidence. So before an auditor can give unmodified report, it means that the auditor must have enough appropriate audit evidence that the financial statement is free from material misstatement. So it means that you must be sure and have evidence to back that this financial statement doesn't contain any material misstatement. Then, two, you must also have evaluate that all uncorrected misstatements are not material. So what we are saying is that when there are uncorrected misstatements, they are they are insignificant. Then the other thing is that the financial statement must have been prepared according to the standard. So IAS1 speaks to preparation of financial statement. IFRS speaks to measurement and evaluation of line item of the financial statement. So when you are giving this type of opinion, you are saying that the financial statement has been prepared in line with that. The other thing is that we are also saying that the financial statement, all disclosure has been made. The right accounting policy have been used, and that the information in the financial statement are relevant, reliable, comparable, and understandable. You're also saying that all the terminologies used in the financial statements are appropriate. So if you look at all these points, these are the expectations that the auditor must have evaluated before giving an unmodified opinion. And how does an unmodified audit report looks like? Basically, in an unmodified audit report, these are the things you will see. There will be the title of the report, the client that is addressed to, the audit opinion. That's where it will state that his opinion, this financial statement is showing a true and fair view and has been prepared in line with applicable financial framework. Then the basis for that opinion. Why is he making that opinion? That's where he will state his audit evidence. Then another thing, mostly these other ones are not, you won't see them in unmodified report. Going concern matter, key audit matters, other information. Usually they are not applicable in unmodified report, but sometimes you might have them. They are most common when an a modified report is issued. But because what you are saying undergoing concern is that the client should pay attention to some area. These are usually based on the risk assessment that the auditor has conducted. Whereas for key audit matters, the auditors want to draw attention to some areas. Whereas for other information, maybe there are other information the auditor got have that wants people to pay attention to, users of the audit report. But basically, what you will have or you must have in an unmodified report, there must be the audit opinion, the basis for the opinion, The responsibility for financial statement. This one will be in all report. Auditor's responsibility. So you have 1, 2, 3, 4. You must always have that. You can have 5, 6, 7 if need be, but not usually common. You must always have 8. 8 is responsibility for financial statement. Then 9 too, you must have that. The auditor's responsibility. What is the auditor's responsibility? The auditor is responsible for carrying out the audit, whereas the responsibility for financial statement lies with who? Management. Then maybe other reporting, that one is not so important. You must also have name of the engagement partner, the auditor signature. These are the basic element of the audit report. During those early days of skills, they used to have this question, but it's not so common now. But it's just good that you have an idea of it. So lastly, we'll be looking at key audit matters. Key audit matters. We must look at one past question before we go to the. Let me see. Okay, key audit matters. So, what are key audit matters? In your text and some textbook, you see them as KM. Now, what key audit matter is saying is that these are areas that the auditor is communicating to companies. Now, when an auditor prepare an audit report, there are some areas that the auditor will pay attention to, or some areas that the auditor will really focus on because he feels that these areas are where he derived his main audit evidence. So he will want to bring it to the notice of the client that, see, these are the areas that I've spent more work and all of that. Now, according to ISA 701, key audit matters must be communicated in the audit report. So most time, before now, some auditors don't necessarily put that paragraph. But now, since 2015, it's compulsory that when an auditor identify key areas, he should put that paragraph in the report. And the definition for it is those matters that in the audit professional judgment were of most significant in the audit of the financial statement. So these are areas that, based on the auditor's own judgment, these are the areas that are very, very important. So he needs to let the client knows. So key audit matters are selected from matters, and most time he will also communicate them to those charged with governance. So based on his risk assessment in the course of the audit, he will say, it's a whole paragraph. And that's why if you look at the form of audit report, you will see key audit matters if applicable. If it's not necessary, if he doesn't feel there are any key audit matter, there is no point putting. But if he identified those areas, the standard is saying that he should put that paragraph and communicate it to those charged with governance. Now there are some things you should know about key audit matters. Number one, it's the auditors that will identify them, not the client. So these areas, the auditor is paying attention to them. He identified them during the audit and is bringing it to the attentions of he is more, the auditor is more concerned with it than even the client. So he's not, the auditor is not making it, he's not saying, it's because the auditor spent more time on it. So he's just saying, I've conducted this audit, but these are the areas that are very, very significant to this audit. There are times that every area will just be on the same level. But imagine that the auditor has 5 main areas that he focused on, and 3 are very, very important. So he will need to put this paragraph. That's what the standard is saying. Now, the fact that an audit report asks key audit matters does not mean that the report should be qualified or modified. A report can have key audit matters and is still an unmodified report, whereas in some instances, once you have key audit matters, it might modify the report. Now, there are some countries that have some special law on how an auditor should treat key audit matters. So, but what we are saying is that an audit report has key audit matters does not mean that the report should be modified. So anytime you see an audit report and you see audit matter there, it doesn't mean the report has been qualified. It just means that the auditor has paid attention to this and is making reference to them so that users of the report will be aware where he spent more time. And that's what the standard is saying. So now, what does the standard state when there are key audit matter? What should the auditor do? Now, or how would the auditor determine areas of key audit matters? The standard is saying that any areas that have high risk of material misstatement or significant risk can form key audit matters. So before an auditor will say, these are key audit matters, it must be an area of high assessed risk or possibility that there might be high risk of misstatement. So if the risk is very significant, it can be key audit matters. Another area or places or issues that can form key audit matters are areas where the financial statement involve significant management judgment. So, like we said earlier, accounting estimate. The management has calculated impairment or provisions. These are accounting estimates. Now, those areas can also form key audit matters. Why? Because estimates are uncertainty. Estimates are not exact. Fair value measurement can be area of key audit matters. Then the last area that can also be key audit matters are significant events or transactions that occur during the period. So there are some entity in the accounting period. Maybe they purchase a new business line or they start a new product. Now, those can form key audit matters. So, what we're saying here is that if in the course of the accounting period or the period under review, the entity embarked on significant transaction, maybe they acquire another firm or there was a merger, those are key audit matters. So, those are the what will form key audit matters. Now, why the matter was considered to be the auditor in that paragraph, the auditor will need to explain why he considered that matter a key audit matter. Okay, what for you to have that paragraph, it means that the auditor have identified some areas. Now, how do you identify those areas? Why do you think they are key audit matters? The auditor will describe and explain it. And how was it addressed in the audit? So take for instance, area of high risk of material misstatement. If an auditor is saying that this is an area of high risk material misstatement, it means that the auditor will be saying, I'm designating this as key audit matter because of the risk assessments I've done. That's how he identified that. And how do you address it? Oh, because we've deemed this as area of high risk audit, high risk. These and these are what we've done. These and these are what audit procedures that were used. Enough substantive procedure was carried out. Test of details were done. So this must also be included in the paragraph. And the form and how key audit matters or how the standard is saying that it how would the form look like? I mean the paragraph rather now. It will, of course, the report will have a title, there will be an address, then and the opinion that will contain the expression, identity of the financial statement, whether it has been audited, and all of this listed there will be part of what will be stated. Reference to ISA, the law of the regulations, and all of that will be stated in the key audit matters too. So, lastly, audit reporting and the company's ally matter. There are some countries that have national law for how audit reports should look like. It's clearly stated that the audit report should be in this format, whereas some countries just allow the standards to prevail. In Nigeria, there is a fifth schedule that states that audit reports should have the following. The fifth schedule can be found in section 404, sub paragraph 2 of Kama 2020. And what is the fifth schedule all about? The fifth schedule is saying that the audit report should also state whether the director have obtained all information and explanation as to which they believe that the purpose of the audit has been done. So the fifth schedule of the KAMA is saying there should be a part in the audit report that speaks to the director having obtained all information and explanation. So this is like when I was talking about board of directors and those charged with governance. So it means that the auditor must have discussed with them and it should be stated there. Also in the report, the auditor should state that proper book of account have been kept or not by the company. So that's the second thing the fifth schedule is saying. Then the fifth schedule is also saying whether the company balance sheet, which is the statement of account, profit and loss, have been prepared in agreement with the book of account and return. Book of account and return are the source document that feed into the financial statement. So it should also be stated clearly. This is Nigeria national law that speaks to audit report now. Then the fifth one is that in the case of holding company who is submitting group financial statement, the audit report should also state clearly whether the group account has been prepared in accordance with the provision of the Act, which is standard and the KAMA law, and whether it shows the state of affairs of the company. Now, these are the expectation of company law, which is Nigerian law, for audit report. For audit report. While discussing and trying to answer the question for by Adedejo, I did mention audit committee. Now, audit committee, you usually see this in public companies, that's listed company, and the audit committees they are like go to for auditors. So, an audit committee, what constitutes an audit committee? You have equal number of directors and representative shareholders. Usually the maximum number is around 6, and they are the one that will examine the audit report, make recommendations before the general meetings. So when an auditor has prepared his audit report, before the audit report is finally signed off, there will be a meeting with the audit committee to review the audit report. Now, the member of the audit committee can be part of the director or part of the shareholder. Now, the functions and objective of the audit committee is one, to ascertain whether the accounting and the reporting policy of the company are in accordance with legal requirement. So the audit committee, apart from reviewing the audit report, the key thing is that they want to be able to assure that the company's policy are in line with legal requirement so that the company is not facing any non-compliance, and also ethical practice. Then the second thing, they want to review the scope and planning of audit requirement. They are one of their key responsibilities is working with the auditors. So the scope of the audit, the planning of the audit is done along with them. Then they review finding on management matters. I told you that sometimes auditors will need to take their discussion further to those charged with governance. Audit committee is one of such. So if they have any matters that borders on management, the auditor will take and get the response from audit committee. The audit committee will also review effectiveness of the company system. Now, the reason why audit committee is very important is that normally management are supposed to run a company profitably. But for public companies, audit committee can serve as oversight function, meaning they are more like management managers. Just like management is responsible for employees, audit committee can also serve like that to management. So they review the company system of accounting, internal control, and in some companies, the internal audit reports to audit committee just to give an oversight to management. They also make recommendation to the board. Now they are not the board, but they serve like in between. So recommendation on who to employ as auditor, when to remove the auditor can be done by audit committee. Now, this is very important because most times shareholders don't have the expert knowledge to know who and who should be the auditor, and you can't leave that totally to management because you don't want familiarity threat and issues around management and auditor colliding. So the best position, the best group to handle external auditors appointment, removal, remuneration is with the audit committee. And like I said, internal auditor can also work directly with audit committee. So let's look at one or two past questions before we call it a day. And why I'm trying to get the past question. If you have any question, you can just let me know. Now I have here November 20 May 2024 question 3 and question 7. We'll just look at that before we go. May 2024. This is just last diet. That's this year. This year, May 2024, and they asked two questions from this topic we just looked at. You see that's very, very interesting. I'm trying to open the Pathfinder. May 2024. Is there any question? Hello, are we still there? Hope we are not sleeping. So May 2024. Okay, let me know if I'll stop sharing the notes so that I can share the past question. May 2024. Let me know if you can see the past question. Can you see the past question?
No, sir.
It's still blank.
Okay, it's not showing yet.
Yes, sir.
Yes, sir.
Okay, I'm coming now. May 2024. Okay. Is it showing now?
No, sir.
Oh,
Okay. How about now?
yes.
Yes, sir.
Okay, okay. So let's look at question 3. Question 3. This is just this year. Can somebody read the question 3? Just somebody can just read the requirement.
Explain two reasons for obtaining letters of representation from client management.
Okay.
Explain 3 steps you will take if a representation by management is contradicted by other audit evidence. Draft a letter of representation which the management of Edinburgh Nigeria Limited will present to your firm.
So you see the 3 questions they ask here is all on letter of representation. And I'm not going to answer this question. I want you guys to go and treat it. I've discussed it here, but I want you to see how the question will look like. Now, if you look at the question in itself, the question is saying you are audit senior in charge of audit of Edinburgh Nigeria Limited. The management of the company made representation to you, which include this, that. You have reported this matter to partner of your firm. Then, so the first question requirement A and B, you don't necessarily even need the question to answer it. The only one you will be needing the question is when you are forming a draft. And I forgot to, if you have your Hican pack, you can check it's chapter 13 now, page 3452. I was supposed to know that. You see the format. The format can be anything, but what will be important is this 3 points that were highlighted in the question. That's what the representation is going to cover. But what I just want to bring to your notice is that just look at A and B. If you go back to your test that was shared today, I told you that there are instances that the management letter that will be issued will contradict what the audit evidence the auditor has gotten. So what is the auditor supposed to do? He said when it contradicts, what's the auditor supposed to do? The auditor might need to consider whether his risk assessment is appropriate, carry out whether he needs to carry out additional audit procedure, and if he feels that these two are fine, he will discuss consider the integrity of the management and let them know his concern. If they still insist, he might need to withdraw from the audit. Now, that's what the first question is saying, that in instances where, that's the B part, explain 3 steps you will take if management's representation is contradicting the audit evidence. Then the first one is asking reasons for obtaining letter of representation. One is to support the audit evidence, and one is so that management responsibility as regards financial statement is clear. So those are the way the questions will come at you. Now let's look at question 7. Just this tale, they ask 2 questions on this topic. Now, can somebody read question 7, the requirement? Is anybody reading?
Explain key audit matters
In
in
relation
relation in
to
relation to the audit report.
2 marks.
Explain explain
Continue.
2 types of audits in which the auditor is required to communicate key audit matters in accordance with ISA ISA 701.
3 marks.
Then draft the key audit matters section for inclusion in the auditor's report of Abati Queries Limited to capture the builder's issue.
6 marks.
Highlight 2 important matters the auditor will consider before terminating if a matter is a key audit matter.
4 marks. Now, if you look at this, the first one is saying explain key audit matters in relation to the audit report. So what we've discussed is that key audit matters are area where the audit feels that are significant risk or have risk of material misstatement. So we are looking at that 2 points, and is also part. The key audit matter is part of the audit report. It can be in unmodified report or unqualified report. The 2 types of audit in which auditor is required to communicate key audit matter according to ISA 701. ISA 701 is your key audit matters. So what are the 2 types of audit? It's still more like the risk that we're talking about. When should when is that, what type of audit will warrant key audit matters? If you go back to your test, now you still have the liberty of going back to your test. And that's why somebody was asking me that in preparing for audit, what should he do? The best way to prepare for audit is after every topic, go back to the past questions that speaks to that topic. Look at the question and go back to the test. You're not writing an exam now. You just want to get it. So there is no, don't cram your head there. When you see the question, go back to the test for now. So if you are doing your revision, once you finish a topic, don't read the whole text or the whole pack and you now start answering questions. You need to familiarize yourself first with the question. So what we're saying here, key audit matters. Now, if you look at the key audit matters, it said there are 3 things you should take note here. Terms are defined with reference to the auditor, meaning it's the auditors that is that paid attention to it. And these are areas that in the auditor's professional judgment were most significant to the audit of the financial statement. So that's why then what the auditor will use to determine key audit matters. Number one, areas of higher assessed risk of material misstatement, meaning area where there are higher risk of material misstatement or significant risk. The second one is when the auditors have areas that involve management judgment, such as accounting estimate, then the effect of significant event or transaction during the period. So there are some major transactions or events that occur in the period. Those are the three areas. Number one, areas of high risk of material misstatement or significant risk, areas that involve significant management judgment, an area of effect of significant events on transaction. Now, the auditors, those key audit matters area, the auditor will describe why he considered them to be key audit matters. What is the most significant reason that is making it key audit matters and how he addressed them. So anytime there is an audit that there are significant risk or anything, the auditors must take note. So that's, if you look at, I think there are still other past questions there. I hope you guys have Pathfinder. Am I right in assuming that you have Pathfinder?
Yes, we do.
Hello?
Yes, sir.
Okay.
Yes, sir.
So what I want you to do for me before next week, during the week, look at this question, November 2021, November 2022, May 2023. For May 2023, question 1, 20, and try and look at them. If you have any issues, just drop it on the chat and let me know. But I want you to look at it very well. This is what we've discussed today. And if there are still any issues, just let me know. Uh, so this is where we'll stop for tonight. It's been nice taking this class with you. Next
Sir,
week, if I'm not around, the other lecturer will be around. Is
sir,
somebody ask a question?
please, sir, kindly assist us in dropping this past question on the group chat, please.
Okay, you mean the Pathfinder, Abby?
Yes, this particular one.
Okay, I will. Let me
Thank you,
know
sir.
if you can see it now. Let me just do it now. To
All
the
right, sir.
WhatsApp group, right?
Yes, sir.
Okay.
Thank you, sir.
Just let me. Okay. Okay. So do have a good night. I'll drop it. Um, I'm still on. Okay. Pathfinder.
Thank you. Good night.
Good night.
Good night, sir.
Good night.
Good night.
Good night. Good night.
Good night, sir.
Good night. To have a, so I've dropped the Pathfinder. I'll let me see. I think I still have one other Pathfinder there. Let me know if you see that one. Let's see, 2023.
That's drop.
Okay. So I'm trying to drop the other ones too.
Okay, that's drop also.
Okay. I think I have November. So these are the ones I. Okay, May 2023. Okay, I
May
have it.
2023 and November 2023.
Okay, let me drop May 2023. I have May 2023 here. May 2023. Okay. Let me see which other one can I get. November 2021. Okay, so please look at the past question, and for other topic to do look at the past question. So
All
good
right,
night,
sir.
everybody. You have
Thank you,
Nice,
a,
sir.
sir.
yeah, you're welcome. You have a good night.
And you too, sir.
Yeah, all right. Good night.